Welcome back. So today's session we're going to cover the compliance cascade. I have here Luke from Keystone Law, welcome, and Jon, our compliance manager at Credas, and Mike from Anderson Strathern, welcome back. So we're going to talk about the waterfall, the AML waterfall and the cascade when it comes to compliance. And I think we talked earlier about the jigsaw puzzle. So there's a lot involved, you know, from your ID verification, your address verification, your PEPs and sanctions, your source of funds, your source of wealth, your risk assessments. And I know, Luke, you've written a piece on what you call the AML compliance waterfall. So we're going to get into a bit of that today as well. But Luke, from your point of view then, with the waterfall, can you give us a brief description of what is your compliance waterfall and what have you written about previously?
Absolutely. So we're all very familiar with what the client matter risk assessment is. It's required on every matter that you open it and how you go about it. But that has to be informed by what you as a firm see as being the key risks across the business. It's about understanding the geographies you work with, the industries you work with, the clients that you work with. But all of that, again, is informed by what the sectoral risk assessment says, and the sectoral risk assessment is absolutely impacted by what your national risk assessment says and what the government thinks are the key issues across the industry or the economy as a whole, and what can be done in order to minimise any risk that parties, whether it's law firms, estate agents, your corner shops that send money through Western Union, what they can do to impact and reduce risk around financial crime more generally. And that's really what the waterfall is about. It's understanding that everything starts from the very beginning, which you might say is a national risk assessment, but even then you've got the Financial Action Task Force sitting above that, working as a supranational governing body of, well, what does good look like in the anti-financial crime space? And what you do in a day-to-day kind of basis has to be impacted by the wider concept of what are we aiming to do more broadly here.
Brilliant. And another acronym, we love an acronym in our sector, don't we? The CMRA, the Client Matter Risk Assessment, sits at the bottom of all this. But I noticed in your piece you argued that it's not actively connecting everything together. So what do you think we can do better with the Client Matter Risk Assessment?
I think quite often people are, and I'm going to say lawyers on this, just establish, well, this is low risk, but they don't think about why. They don't, and it might very well be low risk. It might be medium, it might be high, it might be extraordinarily high, and someone's just entirely disconnected from this, which is because they don't understand what you as a firm think are the issues impacting your business, but equally what the SRA, the Law Society of Scotland, might be thinking as the wider issues that impact the legal sector as a whole. And even then, that all goes back to what government thinks as being the key things that we need to be conscious of. And that's it. It's around, if you are conscious of the issues as to, well, conveyancing, high risk sector, according to the National Risk Assessment and Sectoral Risk Assessments as they are updated fairly regularly. And it's because you are dealing with, let's say, average property price in the UK now is what, 300,000, something like that. You are dealing with 300,000 moving in one quick fell transaction rather than little bits here and there, people not paying their £5 VAT or whatever it might be back to the government, and it's all cash in hand. Those are small incidences, and yes, they add up, but it's going to take an awful lot of those to get to that 300,000, if not dealing with multiples of millions as well on big transactions. This is why what we do on a day-to-day basis has to be impacted by the wider risk assessment broadly, because I go back again, Mark Zuckerberg, multi-billionaire on that basis. The understanding of his source of funds is going to be very different from someone who comes into you day to day saying, I've got a cash purchase of this property, I need to get it through as soon as possible. And if business is slow, you're going to take that piece of work. You need to be able to step back from that and think, well, actually, what are the risks here? And the risks here are impacted by what your firm sees as the risks, the sector sees the risk, and then the government sees the risks.
Would you agree, Mike, or what's your experience of the CMRs?
Yeah, I mean, it's exactly that. I think the only other thing that I would maybe add in, I think, is and this might go against the waterfall analogy of everything coming down, but there's a bit of almost coming back up as well, and it being a bit self-reflective at each step as well. So, obviously you're looking at the national and sectoral risk assessments coming down the way, but when you get through a cycle and you're coming back to look at it again, your client and matter risk assessment, or the outcomes of your client and matter risk assessments, also look back and feed into your firm-wide risk assessment, because you need to know, what am I actually doing on the ground at a practical level, to understand what am I comfortable with doing at a firm level, to be able to say, well, 2 years ago we didn't do this kind of work, and therefore we treated it with some caution. Actually, we're doing a lot of this and we're really comfortable with it now, so actually we can probably temper our response to this work because we are more used to it. We do have a better understanding of it now. So I think there is a bit of self-reflecting to do on the actual work that you do, to make sure that it takes it from being more academic to slightly more practical as well.
I'm going to call up the bubbly fizzy bit at the bottom of the water.
yeah.
Is that officially what it's called? It should be. Makes it sound a bit fun. And does it cause any challenges within the business then?
Yes, I mean, I think, again, going back to the sort of maybe slightly privileged position that a big firm's in, a large firm will have people like me who is quite academic and enjoys it and geeks out a little bit on reading the risk assessments, and it's very much part of my job description to do that. But actually, for, again, smaller organisations who are maybe, one or two people that are wearing multiple hats, again, it comes back to, do I actually have the time to do all the things that looks, suggesting that you do, and they're absolutely the right things to do. But I think people listening to that maybe with a slight bit of cynicism would go, well, where am I getting the time to do that? That's going to be the thing that I do in the wee hours of the morning when I'm actually should be getting some sleep, or it's the thing that I do in compromising, client work or something like that. And I think that's where it comes back to that point around, do as much of that as you practically can do with the time that you think that you have, rather than saying, oh, I'm going to do all this stuff and waste lots of time and actually not really get a huge amount of benefit back from it because you've rushed through it. Yeah. Buy into these practices, but underline with the, here's what I can actually do to do it well with the time that I've got. I
think it's important to see in this space as well, where enforcement typically happens is from the regulators in respect of your client matter risk assessments not being appropriate, or your practice-wide risk assessments not being appropriate, your PCPs generally not meeting the expectations they have there. And that all feeds down from, have you incorporated the latest sectoral risk assessment into your practice-wide risk assessment? Are you making the right referrals to the guidance that you are getting in this space? But you're absolutely right, Mike. It's about time availability for those smaller firms in understanding, well, actually, am I being as, I say aware is probably not right. Do I have time to see this and incorporate it at the right points to ensure that I'm protecting the business going forward? You can do everything you can do on a day-to-day basis of being aware of your red flags, appropriately escalating to the right people. But unless you've got the time to ensure your documentation is correct, sometimes it's really quite difficult to not find yourself in that hole of chasing things after the fact.
I think there's a key decision point for people as well to say, and I'll not plug any one single consultant out there because we all know that there's lots of them, but it would be very easy for a small firm to go, I just don't have the time to do this myself. And actually I would encourage people to go and have conversations with the people out there who do offer these services, because a small amount of investment, right at the very start, a little bit of hand-holding shouldn't cost you an arm and a leg to do it, but will allow you to get through it as quickly as possible, as efficiently as possible, and with minimum cost. And then you can walk away from that knowing that my policy's in a good place, my practice-wide risk assessment's in a good place, I've had some guidance on how to maintain that, but the heavy lifting's been done at the start, and you can go away with kind of, I guess, knowing that you're not going to be wasting lots and lots of time taken away from billable hours, and two, it allows you to operate a little bit with, much more confidence, because you can actually say, an expert's came in, done this, it's in a good place, and I've moved on. So I think if you give it the time you have, but if you don't have the time and you genuinely don't have the time, that's where I think inject a little bit of expert help from someone in the community.
And I think, you know, we talked about larger firms and smaller firms here. You know, a lot of smaller firms are set up from, you know, fee earners going out on their own and starting their own business up, and they're not experts in the compliance realm, you know, and nor do they have the time either. So, like you said, there are businesses out there and that can help them build those policies and build those risk assessments and everything. And there's no harm in that, because, you know, it's not their expertise. So, you know, I think that's a really good piece of advice, actually. Just there are people out there and organisations that can help, paid for or not. You know, we mentioned earlier about the SRA and the Law Society and everything. You know, there's guidance available there for, you know, larger and smaller firms to go after. So I think there's help out there as well.
There is. LinkedIn today is revolutionary, I think, in this space as well. Probably because of people like me trying to get my twopence in as soon as something changes. But it is about that. It's about utilising commentary in this space, guidance in this space, and thinking of it as a resource to work from and to incorporate as you need to, rather than you don't immediately need to jump to paid consultancy in this space if you are able to horizon scan and see what's going on and find the time to do that yourself.
Yeah, I mean, I'm happy to admit that I've got lots of connections on LinkedIn with consultants and people in this field, because they've got the time to do a lot of the research that I don't have, because I'm up to my eyeballs in transactional queries. So my commute to and from work's really good research time, because I have a flick through LinkedIn and there's lots of really good articles and lots of really good posts and little tidbits of things, and even things like, we know that the high risk country list at FATF changes a couple of times a year, but I never remember exactly when it's going to be, and the first time I get the answer is when I see someone posting it on LinkedIn.
It's always a Friday afternoon. It's always a Friday afternoon,
exactly.
And Monday morning.
Hopefully
that's
on
the time you see
your
it.
commute to work, you'll be listening to the Credas podcast going forward. Let's get that in there. Jon, from a Credas point of view then, and the sectors that we deal with, how many firms do you think are generally connecting their CMRA to their PWRA, and are we seeing any big gaps?
I think it's a fundamental point, you know, and you're absolutely correct. There is a waterfall and it feeds down. I think an issue that you'll find quite often is you'll have your practice-wide risk assessment saying that a certain type of transaction is medium risk or high risk, but then the actual client matter risk assessment is defaulting at a low risk. And it's where has that happened? Where's the explanation for why this has gone from being a medium risk transaction into your practice-wide risk assessment to suddenly it's a low risk transaction on the CMRA? And yeah, it's about linking that together with again the rationale and the explanation there, you know.
There's nothing wrong with doing that if you've got the explanation of how you've established that point as well.
And I think that flows on nicely to the different levels of sort of due diligence we need to do, from your standard and simplified due diligence all the way up to your enhanced due diligence. And Luke, you've talked about the waterfall should dictate where you land. Is it the simplified, is it the standard, or is it the enhanced? Like, how do we make a judgment on that each and every time, rather than just default into the simplified version?
That's a really difficult question, more generally. You're not to go back to checkboxing or tick boxing generally, but it's a good place to start. Like, you need to understand what your wider policies, controls and procedures say to approach in this scenario. And that does, everything connects together. Your CDD checklist connects to your AML policy or your AML sanctions policy, and which connects to your practice-wide risk assessment more generally. There's a trifecta of how they work and interact together. And that starts you off on the right way, as to understanding, well, actually, what guides us to the right place in terms of ID&V for this client. Now, your ID&V of your client then impacts what you might do in terms of next steps then. If it's eligible for simplified due diligence, then your ID&V is going to be much lower, and you might say, well, actually, this is an entity itself regulated for AML purposes. Alternatively, you might say, well, actually, there are transparency and governance strengths within the business that allow us to apply a far lower standard on a risk-based approach. And that's it. It's always about risk-based approach and reasonable measures in circumstances as they apply. if it's a far higher risk business, if you've got overseas entities involved, you've got oil, gas, any number of higher risk industries there as well, you might want to go further. You will need to go further even, but everything impacts everything else. It's holistic. It's about understanding. It's know your client, and if you do that well enough, then the notes and the assessment and the documentation, the verification of what you're doing in that space it'll flow. To go back to the waterfall analogy, it is about getting to a place where everything flows into one another to be able to come out at a reasonable conclusion.
I think on a practical level as well, there's a misconception that you can't build system-driven risk assessments. Absolutely rightly, the regulator doesn't like exclusive system-based risk assessments, but I think for me there's almost like a three-stage process that I like to try and implement as much as possible. A system-driven framework that is absolutely linked to my practice-wide risk assessment and my policy, so that I can immediately, as a fee earner's filling in the risk assessment, tell them at the end, based on the parameters of our practice-wide risk assessment, we believe that it's this level of risk. Then they have that ability to get a bit of artistic license to say, well, actually, your risk assessment doesn't think about this, so we could argue it down, or actually, not that it happens all that often, but they could say, oh, there's a wee extra bit here, and no, I do want to bump this up a little bit. And then the final step is going, well, taking the academic, taking the practical together, what's my conclusion at the end? And then that just gives you that ability to more meaningfully tie your risk assessment to your PWRA, but still allow a bit of flexibility and discretion to reflect the situation that you've got in front of you.
Yeah, I think that's a really interesting point. The whole idea of automating or introducing a scoring matrix into the client matter risk assessment, so it's scoring it based on aspects of the PWRA or known risk identifiers, and then again, it's how far do you go, and where does the human intervention come in? But especially for reporting purposes as well. If your client matter risk assessment, you're reporting on the different themes that your general client base, that your fee earners are coming across, that again is an easy way to feed up and inform your practice-wide risk assessment. Yeah. So
and I think a lot of what we're talking about over the course of today can sound complicated, expensive and time-consuming, but actually a lot of this is, there's very simple tools out there. I've seen firms deliver automatic risk assessments through spreadsheets, and it works. They've done it in a way that's it guides the fee earner at the start to say, well, I don't want to go away and look at the practice-wide risk assessment. I don't want to go away and read the policy. Give me a quick tool that just helps me, guides me in the right direction. So there are ways to do it, at the right price point with the right time spent on it, and still make it work for your firm.
Striking that balance, yeah.
Mm-hmm. And on that note, Jon, how do you think technology, can help with this?
Well, yeah, leading back to that, yeah, I think certain automated aspects of a risk assessment, if you've got one plugged into your case management system, so that on every file that you're working on, the tech is, and you can have it as a compulsory to complete control. If you're using your case management system to make your risk assessment something that you have to complete and perform before you can move to the next stage, particularly with volume conveyancing or something like that, before you can even move to exchange of contracts, you're making sure all of these things are completed via compulsory controls. It's a good way of easing the management burden, the supervisory burden, and also you're getting good reporting out of that, because everything's getting completed and it's feeding up, and you're getting MI off it to make more informed decisions. It's really interesting, the whole automated scoring matrix, because again, regulators will push back on this, on scoring matrices and it being too automated, because then I think there's an argument that you're kind of missing the point of that interpretation of the risk and the evidence that you're looking at. But on the other hand, it can be so helpful in so many ways, and saves that fee earner having to keep going back and referring to the practice-wide risk assessment, because they've got it there already scoring each question to a certain point. So again, I think it comes down to balance very much, and a link between case management systems and protocols and processes, and trying to ring fence that journey in with robust technology.
you were saying it earlier on, there's no silver bullet in AML, you know, and I think in fairness to the regulator, I think what they're coming out against is that, oh, well, I've got a tool that does this for me, and I just plug it all in and then forget about it. They're coming down really, really hard on that, because we've had years of that, and the message needs to land that that's not acceptable. But if you are building that in as part of an informed process that's staged and you can see the workings of it, then I think the regulator is happy with that, and I don't see why we can't be doing more of that sort of thing.
And then it's how far do you go with it? You know, do you have a score from 1 to 4, from 1 to 100? Is it in percentages? You know, it's this percentage of risk, it's that, and it's a really interesting beast, and it's that link between human interpretation and what the technology can do to apply formulas to risk management. You know, it's I find it really interesting, that stuff.
And then comes the issue of updating these policies then as well. Like, how often should they be updated, maintained? I mean, Luke, you've mentioned that CMRAs are the point where sort of the rubber meets the road. You know, but how often should we be updating, you know, these policies and maintaining them?
Policies annually at the very least. I think you need to be able to say that you have understood the compliance landscape as a whole, and this is what you are feeding back into it, whether from the bubbly fizzy bit at the bottom or from the National Risk Assessment downwards as part of that. In terms of, I think, client matter risk assessments, it's sometimes very difficult to do that, but this is where ongoing monitoring comes in play, and understanding that you are building out a compliance culture as part of this. I'm sure we've all had experiences with fee earners who don't really want to be doing the initial client matter risk assessment, let alone another one midway point and at completion again. But it's about this again about that compliance culture. It's getting people to understand and want to speak to you, to say, actually, something has changed here. Getting people to stick their hands in the air and say, this is something that needs to be discussed, because it goes back to the point around red flags. We can't expect our fee earners to know the 36 or so red flags that they need to be considering. We will have built it into the client matter risk assessment more generally, but getting them to recognise that funny feeling in their tummy and speak to the right people at the right time, you get that right, everything else flows from that.
I think the idea of, you know, it is so important to have a compliance culture, but I think the question is, how do you build a culture? You know, and the answer really is being diligent and vigilant to things like your policies, controls and procedures, making sure that they're meaningful and updated to what's going on at the moment, making sure that you're capturing that information from your live client and matter risk assessments that are looking at the transactions your fee earners are dealing with at that time and that are relevant to them, and so it all feeds together.
I think the point I'd make as well is it's around recruitment culture as well. You get the right people in the door at the right time, they'll want to buy into that. They want to buy into, well, this is how we do things here, and compliance somewhat flows from that. for me, you get the right people doing the right things at the right time, and everything works together as a machine, as it should do.
Just a couple of extra points, just going back to the sort of policy and practice-wide risk assessment review. I think one point to make clear is updating doesn't necessarily mean wholesale change. You could review your policies and procedures and your practice-wide risk assessment and say, objectively, nothing's really changed in the last 12 months. I'm still a conveyancing law firm. I still deal with local clients. Therefore, I can put in the sort of version control section, say, I've reviewed it and nothing's changed, dated and signed off, and that is enough to say that you've updated things. But if the SRA or Law Society come in and say, oh, actually, you've acquired another business, or you've branched into private client or commercial real estate, but you've not updated your risk assessment, that's where you're going to get found out. So there's an element of regularity to it, but there's also an element of trigger-based reviews. And I think maybe just to flip that on its head entirely, one of the very real risks that we're seeing at a practical level is change fatigue. There's so much changing happening in the in the sector as it stands, just without us tweaking and moving and changing things. So I think we do need to be mindful that we're not getting into a habit of changing for change's sake. If there is, like, you go, yeah, if I was being perfect here, I'd tweak that a little bit. But if that's then going to have a knock-on effect of having to retrain your teams and actually have to go out and affect the way that your fee earners are working, then sometimes there's a degree of going, well, is it actually worthwhile doing the change? Yeah. Is good enough here? So yeah, I think change fatigue is something we need to be concerned about with all of this stuff that's going on.
Training, of course, as well, is a massive part of it as well. It's like the glue that holds it all together, and it's very...
And we've talked a lot about all these policies, keeping them up to date, and all of the bits and the pieces of the jigsaw puzzle that goes together with the whole compliance landscape. But we've also mentioned about smaller firms, and I think the biggest challenge here is resource. And things are changing all of the time. I think the biggest challenge small firms are going to face is resource, especially when they've got to retrain or update training, update all of these documents. I mean, how a firm's going to cope, or how can they cope with all of this?
I think there's an element of, do they need to cope with it? If you are a small high street firm, my local town has a conveyancing firm in it, and it does conveyancing within about a 5-mile radius. Yeah. Did they really need to worry about the Russia's invasion of Ukraine or what Donald Trump's doing in Iran? I don't think they really need to. So I think there's a degree of small versus large that I think sometimes gets in the way of small versus large exposure. So you could be a very, very small outfit, but you deal in cross-border finance transactions, trade-related stuff. Your exposure is going to be huge as a small firm compared to a large firm that's domestic and doing conveyancing. So I think there's an element of, as part of all this stuff that we're talking about practice risk assessments and policies and reviewing different, industry and national risk assessments, it's about, think about that in relation to where my exposure is, based on what I do, where I am, who my clients are. And then I think you can manage your time better that way.
It's about, we do this, but why? Why do we do this? Explain away in your language relevant to your practice why you are doing what you're doing and why that's proportionate and defensible, given what you are seeing on a day-to-day basis. That's ultimately what the regulators want to be seeing, is that there's thought going into this, rather than just, okay, there's a new set of money laundering regulations, I need to refer to that. There's a new sectoral risk assessment, I need to refer to that. It's about showing that yes, your exposure is very low to these geopolitical events going on, but why? Why is that? Yeah.
And is it effective? I think that's a key point about it. Is how effective these controls are to the work that you're doing. And again, showing why that is. And I think we're seeing a real steer that way, don't you? I mean, with the guidance that's coming out now sectorally, and with the amendments to the money laundering regulations that have been drafted, it's trying to make CDD more efficient, and not these blanket policies and approaches to things. It's really honing in on the risk areas and what the effective controls and procedures are to have in place to mitigate those risks.
Thank you very much for joining me today, and we'll look forward to the next session.
Thanks, Rhian.
Thanks, Rhian.